Well, good morning, everybody. Economists are always optimistic by nature, really, I should say, and that's why my CV says over 30 years rather than under 40, because it clearly is a more optimistic slant on the true numbers there. But there's been plenty of reasons for economists to crack open the champagne in recent times. And when I look back over the last year, well, we got to the end of 2017 and discovered that our forecasts at the start of the year were actually right. So good result there. During the last year, we completed 26 years of growth in the Australian economy. We're now at year 27. Pretty good track record to celebrate there. And more importantly, we finally overtook the Netherlands as the country with the longest running economic expansion of the modern era. So clearly a good excuse to crack open the champagne. And I think we're going to need a bit more of that in 2018 as well. Because a lot of the key economic themes that are playing out this year we think are pretty positive. So we're starting the year against a backdrop of a synchronised global upturn. The global backdrop is probably the most positive it's been for Australia for a long time. We ended 2017 domestically with a fair amount of momentum in the economy, and that's flowed through to the early part of this year. It is, for various reasons, I think, actually getting easier for the Australian economy to grow. And a fair amount of that growth story appears to be locked in. Now, there are some risks, and I'll talk about those, but certainly a lot of that story looks pretty positive overall. As I said, a positive global environment. It's the first synchronised global upturn that we've seen since 2011. You run through the forecasts the experts put out there, like the International Monetary Fund. What they're saying is well over half of all the countries in the world will have not only positive growth, but an accelerating growth profile. And if I bring that back to Australia's major trading partners, that around about 75% of those trading partners will have this accelerating growth profile. It also looks to be a sustainable upturn because it's going hand in hand with a lift in world trade, with a lift in global capital spending, and with big improvements in labour markets around the world. And these are all the sort of things you need to keep the mix moving along. There's a couple of other aspects that I just highlight from an Australian perspective, and the chart on the left-hand side here just shows you a couple of indicators, and the point about these indicators is they show that global growth is skewed in a way that favours Australia. So we look at things like semiconductor sales, the purple line on that chart. It's a pretty good leading indicator of what's happening in the Asian region, and that, of course, is the most important part of the global story for Australia. We also look at things like industrial production because it tells us about the type of growth. And clearly the growth we're getting right now favours industrial production, and in the end that's what drives the commodity story that's so positive for Australia. So it's global growth in the right places and the right type of growth that's going to work pretty well for us this year, we think. There is one risk factor here to, I think, take note of in the global story, and that is there are a range of indicators that's starting to suggest that maybe inflation is also turning around. So the excess capacity in labour markets around the world is disappearing. The excess capacity in product markets is disappearing as well. And just one other indicator, again, of relevance for Australia, the chart on the right-hand side here shows you what's happening with Chinese manufacturing output prices. So basically the cost of all those things we like to buy from China. Up to about the middle of 2016, those prices were actually falling. So China was exporting deflation to the rest of the world. That's clearly turned around now, as you can see at the end of that chart, and China's now exporting inflation, and import prices into the advanced economies, the other line on that chart, are picking up as a result. And I highlight this inflation story because if you think about the financial market volatility of the last few weeks, well, what it was triggered by was some indications that maybe inflation was starting to pick up. So inflation, market volatility, these are some of the potential global risks to keep a close eye on this year. Well, if we move back to the domestic story, we did finish last year with a fair amount of momentum, and that has continued into this year. And one way of illustrating that is by one of the business surveys the Commonwealth Bank sponsors. It's called the Purchasing Managers Index. It surveys manufacturers and service firms in Australia. It's constructed by this organisation called Market, who do the same thing for well over 40 different economies. So it's a very important statistic, both domestically and globally as well. Because we sponsored is in fact the Commonwealth Bank PMI. Now that's the advert. What is it showing? Well, you can see on the chart on the left-hand side here the latest readings. And the way this survey works, anything above 50 means expansion, and the further above 50 you are, the stronger that expansion actually is. And you can see that acceleration coming through in both manufacturing and the services side of the equation. This is happening against a backdrop where a lot of the economic parameters that drive the economy are actually pretty favourable as well. And I'll just pick one of those. And I think it's a much underappreciated statistic. It's what's on the chart on your right-hand side there. Shows you what's happening with unit labour costs in Australia. And the answer is, well, not much is happening. They've really been tracking sideways for the last 6 or 7 years. And that flat trajectory means that the demand for labour has been very solid. In fact, there are more people in jobs today than would have been the case otherwise if unit labour costs had just continued to rise the way they normally do. And it's also something that's actually increased the export competitiveness of the Australian economy. So it's making us a better place to be able to benefit from that synchronised global upturn that we're seeing right now. Why is it going to get easier for the economy to grow? Well, that really comes back to the commodity story, the sort of boom-bust feature that's been a dominant part of the economic story for quite a while now. And I've managed to fit all of that story onto this one chart here. And it shows you the three sort of successive booms and busts that we had. So we had a commodity price boom that boosted Australian incomes. That led to the biggest mining construction boom that we've ever seen and employed a lot of people. But of course, when all those things rolled over, that stimulus in fact became a drag on the economy. But the point I note about that chart when you look at the end is all of those lines have either bottomed out and picked up a bit or look like they're levelling out. So the drag on spending from falling mining capex is almost complete. The drag on jobs is almost complete, or in fact appears to be over on the numbers. There's a lot more income flowing into the Australian economy, and this is particularly evident in government revenue. The budget figures are well ahead at the Commonwealth level of expectations, and it means the chances of us holding onto our AAA rating are much improved as well. But from a growth perspective, it's just like a mathematical equation. If you take out all the negatives, then what you are left with are positives, and that's why I say it's actually easier for the Australian economy to grow from here. Well, where's that growth actually going to come from? Well, looking ahead, a lot of the key drivers of the Australian economy look to be pretty much guaranteed. Now, I always hesitate to use that word because nothing ever is, but a lot of what is happening now looks locked in by the nature of what is actually happening. And just to pick a couple of examples on the set of charts here, on the left-hand side shows you mining output. If you look at the brown line, iron ore, well, there was a huge payoff from all those new iron ore mines we built in terms of increased iron ore production and export. And the next line that's going to move is the red line. As all those LNG plants that we've been building are turned on, we're going to see a huge expansion in our production of LNG and export of LNG as well. It's a guaranteed contribution to growth because we've already sold that gas. So we've got to produce it and deliver it. And as we've discovered, we may have sold too much of it, and that created some other issues in the economy. But nevertheless, in terms of GDP growth, that bit is coming through. In a similar sort of vein, and really another part of the Asian story, I suppose, is the combination of demographics and income that we're seeing in the region. Asian income's been growing strongly for quite a while now. In fact, per capita income in Asia is now above the global average. And of course, if you multiply that fact by the 3.5 billion people in Asia, then you've got a very powerful driving force for the Australian economy. And you can see it right now clearly in areas like tourism and education, which, courtesy of the strength of this Asian income story, are now actually in our top 5 exports overall. And plenty more upside to come from this story, we think. And we can add into the mix there areas like agribusiness. It'll be important for manufacturers, I think, and also for areas like health and financial services. These are all big bits of the Australian economy that can benefit from this Asian income story. It's guaranteed because demographics continue, and this income story looks set to expand as well. The third element of this guaranteed growth is government infrastructure spending. Pretty much everywhere you go these days, there are major projects underway, and this very colourful chart that kind of hits you right between the eyes just gives you a bit of a feel for what's happening in terms of all the major transport infrastructure projects that are underway in Australia right now. The point about this is these are projects that have largely started. They're multi-year projects, and because they've started, they're going to run through to completion. and that's why it's going to be a guaranteed contribution to growth, because typically you don't stop building a tunnel halfway through. Somebody did very kindly point out to me there is a website called Bridges to Nowhere, so nothing in life is ever guaranteed. But moving on from that, there are a couple of points about this Asian income story I think that are really worth emphasising, and one of them is just the size of the stimulus it can impart to the Australian economy. This chart here, it shows you our attempt to estimate how fast of those bits of the Australian economy that are exposed to this Asian income story growing. And the answer is over the last 2 years that sector has grown by about 3.5% a year. The overall economy has only run at 2.25% a year over that period. So the question we've all got to ask is which bit of that economic story do you want to be in? And that's why I say that's where a lot of the upside potential is for Australia, and of course for South Australia as well. The other emerging opportunity in the Asian story, I think, is not so much the question we often get asked, well, is there a new China coming up? Will India be the new China and the like? Well, the answer is probably not over the time period that we're talking about. But there is another initiative underway that's worth having a very close look at, because it has the potential, I think, to be a new China, and that is the Belt and Road initiative. The idea is to stitch together more than 60 economies through a sea lane, the blue line on the chart there, and a road, the purpley coloured line. Somewhat confusingly, the sea lane's called the road and the road's called the belt, but you kind of get the general idea here. And these 60 countries, they have about half the world's population in them and account for around about 40% of global GDP. So if you can stitch them all together, then certainly that is potentially a new China and an area that's going to require, firstly, a lot of infrastructure spending. In fact, the experts are looking to say somewhere between $4 and $8 trillion will be necessary to build all the ports and railways and so on that you'll need. And all that's going to generate a lot of extra income again. So this Asian income story broadens out, and potential opportunities for everyone. Now, this is not just lines on a map, it's actually happening right now. You can track the new orders associated with building this Belt and Road, and they're already running at $145 billion a year. So again, opportunities to watch. Now, there are a few risks that we also need to talk about, and the two I'd highlight this morning is, firstly, again, something that we're picking up from our PMI survey, and that is we're seeing an increase in the backlog of work to be done. So the orders are coming in, but you can see on that green line, the companies are increasingly telling us they can't keep up with that work. At the other end of the process, the other line on that chart, well, as that line goes down, it means that supply delivery times are actually increasing. So you've got a couple of indicators here that's saying we're hitting some capacity pressures in the Australian economy. So what we really need to see happen here is business to lift their capital spending. They need to expand. If they don't, then there's a risk that we don't get the full benefits of that positive global backdrop and the positive domestic factors at work as well. So something we'll be watching very closely. The other risk, and the one that's quite topical at the moment, is the combination of weak income growth and very high levels of household debt. And you can see the big picture here on the chart on the left. Australian households, the debt in that sector is now equivalent to about 125% of GDP or 200% of after-tax income, depending which one you want to look at. It's a record high. It's one of the highest ratios in the world. It's coinciding with this extended period of weak income growth, as you can see on the green line on that chart. And this has been in place for long enough. I think the risk here is it's actually changing consumer behaviour. So consumers becoming less responsive to the good economic news and potentially more reactive to any negative shock that may come along. So this is certainly a new kind of risk in the consumer story to watch pretty closely. And it's also going to have some big implications for interest rates because that increase in household debt has increased the interest rate sensitivity of the Australian economy. And you can see it on the chart on the right-hand side, which shows you what share of income is used to service debt. And the answer right now is about 6%. The last time that peaked was in 2008. To get to that peak level, the Reserve Bank pushed its policy interest rate up to over 7%. It would only take a 4% cash rate today to get to that same level. So certainly we're going to be far more sensitive to the interest rate story than in the past, and particularly with the Reserve Bank itself signalling the next move is likely to be up. Then again, something to be ready for in all of our businesses. And just finally on that interest rate story and currency story to go with it, Reserve Bank's done nothing since August 2016. and I think that'll be pretty much the story for most of this year as well. What the Reserve Bank has done over the last year or so, though, is they've given us an increasing set of numbers that map out what they think is a normal Australian economy. So normal GDP growth is 2.75%. And in fact, the table on this page here shows you all of those numbers they've given us. The chart is my attempt to squeeze them all onto the same chart, and it's a little bit complicated, but all those factors you can see around the outside of the chart. The green line shows you what a normal economy looks like according to the Reserve Bank. The orange line is where we are right now. So we're still short of normal, and so the need to shift interest rates higher is still not there yet. But certainly by the end of this year, we think the economy will look increasingly like normal. The case for normal interest rates will be there, and we expect to see the start of a fairly modest tightening cycle beginning on Melbourne Cup Day, so an easy day to remember. And hand in hand with that kind of overall backdrop, we do think there's some more upside to the Aussie dollar. We have it at 83 cents against the US currency by the end of the year. I'll stop at that point, and thank you for your time today.